In 2019, a young engineer named Eva living in Boston found her dream job, applied for a nice apartment, and was immediately approved when the landlord asked, "What is your credit score?" And she answered 800, while her friend Mike, who worked at the same company and earned the same salary, was rejected because his score was 580, asked for 3 months' rent as a deposit, and even required to find a guarantor. Although they were identical on paper, one was considered trustworthy and the other risky, perfectly illustrating the power of the credit score, an invisible 3-digit number that opens or closes doors throughout your life. Because a credit score is a measure of financial reliability, typically ranging from 300 to 900, calculated in Turkey by institutions like Findex and KKB, and checked by banks, landlords, employers, and insurance companies like a financial report card. This score is mainly based on 5 factors: payment history, 35%, credit utilization, 30%, length of credit history, 15%, new credit applications, 10%, and credit mix, 10%, meaning that using too much of your credit limit or missing payments lowers your score, while keeping balances low and paying on time raises it. For example, a credit card with a 50,000 Turkish lira limit and a 45,000 Turkish lira balance means 90% utilization and hurts your score, while a 5,000 Turkish lira balance means 10% utilization and helps it. And similarly, 5 years of regular payments can add significant points, while late payments, prolonged delinquency, or collection records can sharply reduce it. Score ranges have real consequences, from very bad, 300 to 579, where credit is nearly impossible and interest rates are extreme, to excellent, 800 to 900, where borrowers receive the lowest rates and easiest approvals, with average scores around 650 in Turkey and 716 in the US. Credit scores affect almost everything, including credit cards, mortgages, auto loans, renting apartments, job applications in finance or security roles, insurance premiums, and even phone subscriptions, often creating massive financial differences over time, such as 2 people with the same income paying hundreds of thousands more in interest simply because one has a lower score. Historically, the modern credit score system was developed in 1989 by FICO in the US, spread globally over time, began gaining traction in Turkey in the 2000s, and contrasts with systems like China's social credit model, which also evaluates social behavior. Improving your score requires paying all bills on time, keeping credit utilization below 30%, ideally 10%, avoiding frequent credit applications, maintaining old accounts, checking reports for errors, and clearing old collection records, while being aware of risks such as identity theft, fake debt collectors, credit repair scams, co-signing loans, divorce-related joint debts, and inherited obligations. Globally, credit systems vary widely, from strict models like Germany's SCHUFA to countries like Japan, where formal credit scores are less central. And today, technology and fintech companies increasingly use AI and alternative data such as rent or utility payments, making financial literacy more important than ever, because while a credit score may seem like just a number, it represents financial freedom or restriction. And in a modern economy where having no credit history can also be a disadvantage, managing this score strategically is essential, as it is not merely a credit card issue, but a key determinant of your quality of life and your financial future.